Hey everyone, welcome to Property Finance with Lee and part 6 of our Ultimate First Home Buyers Guide series. In today's video, we're going to explore the most important component to financing your first home, your borrowing capacity. If you're new to the channel, don't forget to subscribe and turn on notifications so you don't miss out on the next part of this series. Let's start. So far in this series, we've explored grants you may be able to use, the costs associated with the purchase of your home, your deposit, and how to assess your financial situation, which we will need to work out a borrowing capacity. Let's start off with what borrowing capacity is. Put simply, borrowing capacity is the amount of money an individual or entity can borrow from a lender based on various financial factors such as income, credit history, existing debts, and the lender's lending criteria. Where people get confused is thinking that borrowing capacity is the same across all lenders. This is incorrect. One of the most important variables of calculating borrowing capacity is the lender's lending criteria. Because of this, the maximum borrowing an individual can attain changes quite substantially from lender to lender. This is where the expertise of a mortgage broker, like myself, comes into play. Rather than going to a single lender, we assess your financial situation across a large range of lenders and their lending criteria to ensure that your borrowing capacity for that lender allows you to purchase the property you're after and ensure that you're getting looked after on the interest rate applicable to your loan. So why does borrowing capacity vary so significantly from lender to lender? There are many reasons, but just to give you guys an idea, I'll talk about a couple. Some lenders, for example, will shade the income from overtime and bonuses, not allowing the full 100% of these payments to be used in the calculation. Another reason is how they determine your household expenditure using HEM figures, which vary between lenders. HEM, or Household Expenditure Measure, is a benchmark lenders use in determining your monthly living expenses. If your application shows living expenses less than the specific lender's expected HEM, your application will be scrutinized to ensure that this is really the case, and sometimes they will still judge it on their own HEM figures. There are so many factors that affect borrowing capacity. We could talk about the different max debt to income ratio lenders use, the minimum credit scores they require for certain products, or different monthly net disposable income amounts they require. The truth is, there is just too much that goes into it for the purposes of this video. To provide you with an illustration of a couple of the factors I've just spoken about, have a look at this example. Here is an example of an individual earning 80k base income with 40k in overtime, which is shaded by one lender down to 70%, and judges HEM at 2500. And here is another example of a lender which does not shade overtime and judges HEM at 2250. You can see how substantially different the borrowing capacity calculation becomes. And this isn't even an extreme example. So, how can we increase our borrowing capacity? The answer to this depends on two factors, income and costs. The simplest way is to earn more money, as all your expenses and liabilities are judged against your income. Earning more of it will increase your borrowing capacity. Please note that if you're considering changing employers for a greater income, a lot of lenders require you to be working with the same employer for a certain period before they will consider your loan application. If changing industries, you will need to be in your new industry for an even greater amount of time for a lot of lenders out there. Another way is reducing your day-to-day costs with good budgeting. This will also help you save for a deposit quicker. I know I talked quite extensively about HEM earlier. The truth is, most people's expenses sit above HEM. There are a few ways you as a borrower can easily increase your borrowing capacity. Reducing your expenses down to at least the bank's HEM expectation is something in your control, which will increase your borrowing capacity. As you can see from this example, a credit card or personal loan destroys your borrowing capacity. Closing down credit you do not need dramatically increases your borrowing capacity. For other debts, you need to make an assessment. Work out whether the increase in borrowing capacity from paying off that car loan, for example, is worth chipping into your deposit. For those of us who went to uni and have gone through the mortgage process, we know all too well how much HECS destroys our borrowing capacity. The indexation for HECS, due to the inflation rate recently, has been astronomical. Thinking about getting rid of this liability at some point should be a consideration. I have a borrowing capacity calculator on my website. I'll link it below. However, I would not put a lot of faith in it. There are a lot of things like HECS, which is omitted, and when you do your calculation, it is important to add an interest rate buffer of 3% on the current interest rate, as most lenders will judge your application at the stress borrowing rate. And just to drive the point about the difference in lending criteria, Not all of them will judge an application 3% higher than the current rate. If you're wanting to do this yourself, to ascertain a better borrowing capacity estimate, you should visit each lender's website and perform your borrowing capacity there. The truth is though, there are so many other factors when working out what you can borrow on a given property. For example, certain lenders will not lend out to certain postcodes, or may lend out at a reduced LVR, meaning that even if you have really high borrowing capacity with a specific lender, you may not even be able to borrow the full amount of your borrowing capacity for a property you found from them. The different factors mentioned in this video are but a snapshot of what goes into working out your borrowing capacity. It's what keeps us as mortgage brokers in business. We ensure that your financial data is entered correctly to provide an accurate estimate of your borrowing capacity specific to that lender. A major point of difference is that rather than filling out the calculators on a lender's website, we fill out lender serviceability calculators, which provide a much higher degree of accuracy of a client's borrowing capacity. If you followed the previous parts of this guide, up until this point, you could have done a lot of the legwork yourself. Now you're getting to the business end of this process, and if today's video has taught you anything, I hope it has explained the importance of getting a mortgage professional to provide you with an accurate estimate of what you may be able to borrow and what to consider. Guys, my service is free. It costs you nothing. I am paid by the lender on the successful settlement of your home loan. You should leverage the expertise of a mortgage broker during this process. If you found this video helpful, please give it a thumbs up and don't forget to subscribe to catch the next part of the series. Also, if you found a property and want a free property report, follow the link in the description, provide us with the address and we will email it to you. Thank you for joining me today. Catch you next time.